Good afternoon, ladies and gentlemen, and welcome to the Duke Royalty Limited interim results for the period ending 30th of September 2021 presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab. Just please simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. This will be available via your Investor Meet Company dashboard, and we'll send you an email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure that'd be most welcomed by the company. And I'd now like to hand over to Neil Johnson, CEO. Good afternoon.
Well, thank you very much, Mark, and thank you all, existing shareholders and future shareholders, to this presentation. I'm going to skip over the disclaimer slide and just a brief overview of the company. We won't belabor this part, but it does warrant just an overview for everyone about Duke Royalty. We are an alternative finance company. We provide a minimally dilutive capital that are investing by way of a participating long-term loan, which we'll get into. And we're looking for private companies that are owner managed to a degree, and also have existing strong cash flows that are looking for capital. And the two most important things that we provide those investee companies or those owners is that we don't have dilution, and we eliminate the refinancing risk, and that keeps them in control of their future. And they are the ones that do not want to sell their company, and so that's what we're looking for. We're not doing public companies. You can't buy them elsewhere in the stock market, so we'll get into what we do, how we do it, and what our current portfolio is. But just a snapshot of our opportunity. We've been it's almost 5 years now. We've invested 155 million pounds since inception. We have some buybacks. We'll talk about that. We have 12 royalty partners, as we call them, because we have a long-term view on these companies. They're real partners of ours. So we have 12 different companies in our current portfolio. We talked a little bit about the COVID resilience. I'll get into that as we look to the future. But for our investors, what we provide is a real strong dividend yield, because these investments are long-term. They're very visible. They're very predictable. We have a very nice cash flow, and we commit to a quarterly dividend that we increase as much as we can, because we want a strong payout ratio, and we reward our shareholders every quarter. We're going to get into this is the half-year results from April 1st to September 30th. I'll be handing over to Hugo Evans, our CFO, in just a second. But I want to leave you with this is a record set of results. We have shown now the operating leverage that we have, because we are not a fund. We are salaried employees, that as we grow and as we keep adding to the capital base and investing, our operating expenses are relatively fixed, and that's kicking into gear our operational leverage, which we're really excited to show you today. And then finally, I'll be handing back after we go through a couple examples of our portfolio, really talking about the future. And we're excited about showing you these results, but we're even more excited about what we see in our growth for the next 12 months. So I'll leave you with that little tidbit. Going on to the next slide, just as a refresher. Now that they're, in the 5 years that we've been listed, have been a number of different royalties funds that have gone public, and probably Song Royalties is one that you have heard of. We are a corporate royalty, and just so you just so we for a minute recognize what the differences are. We are more akin to a corporate mortgage or a long-term participating loan. And the royalty aspect is not a fixed percentage of the revenue of the company, because these are operating companies. The great news about us is that we are investing in a lot of different industries. We think that decreases risk, it diversifies our revenue stream. We are insulated from one exposure to one industry. So we're investing across industries, across currencies, and also across geographies for a broad portfolio. So corporate royalties are adjusted once per year with a collar of, we get cash month one, and there's a collar of plus or minus 6% in currency terms on our cash receipts, and that is mapped to the revenue growth or decline of the company from 1 year to the previous year. So that's how the change in our revenue, if we grow, if we do our job right, our embedded cash flow from our existing investments will grow into the future as the company grows. And that contrasts with a lot of other IP royalties that are depreciating assets. If you get a royalty from a song that's played, and that song will become less and less popular as new music takes over. And same with oil and gas, depreciating asset of an oil well. So that's a key difference. But I would say one thing, that as you'll see, that these 30-year agreements can be bought out. That, for a shareholder's perspective, actually is an increase to our return. So that's a good news story. But we take that capital and have to reinvest in other deals and other companies. So the company can pay back royalty like your home mortgage. This corporate mortgage, you don't have to live in your home for 30 years. You can get out of it with the penalties. So I think that's what I'll say about how we do what we do. Happy to take any questions if there's specifics in the Q&A session. Okay, why don't I turn to Hugo now on the financial highlights.
Yeah, many thanks, Neil. Afternoon, everyone. As Neil said, I'm delighted to be presenting what is a record set of results for Duke. I'll touch on, sort of go into a bit more detail on both the cash flows and the balance sheet, but just to start with really some financial highlights for the interim period. Top line cash revenue achieved a 7.8 million. That's up from 4.4 million in the equivalent interim 2021 period. Operating cash flow of 5.2 million, again up from 3.6 in interim 21. Adjusted earnings per share, which removes the effects of fair value accounting, was 1.39 pence a share. Again, this is more than 50% up on the interim 21 period of 0.87. We reverted back to a cash dividend. This, for those of you that remember, in the prior period during COVID, we actually went to a scrip dividend for a couple of quarters to preserve our cash. We're now back to full quarterly cash paying. So the dividend per share was 1.1p for the period. We took on 3 new royalty partners in interim 21, in interim 22, which is great considering we'd put the brakes on investments this time last year. And I think Neil will come on to a little bit later, sort of the opportunity that there is in the market at the moment and how that's transferring into our pipeline. And those 3 royalty partners equate to sort of 24 million of total capital invested. So moving into a bit more detail, as most of you know, I always will point people to our cash flow statement rather than the income statement, because it's the cash flow statement that really gives a true indication of our operating performance. The income statement includes lines for fair value accounting, which are accounting adjustments, whereas the cash flow is a true measure of actual cash received from our royalty partners. So it's great to see, the metrics and the presentation. You'll see top line cash revenue of 7.8 million. That's up almost 80% from the prior period. Operating cash flow up almost 50%, and free cash flow up almost 60%. Now, free cash flow is a key number because it's that number really which drives the dividend, and it's the cash available for us as a company to distribute to our shareholders. And actually, I'll touch on that now. As you'll see in the other cash flow highlights, we had a payout ratio for interim 2022 of 70%. So we pay 1.1p of a dividend. Historically, Duke has always had a very high payout ratio. In our admission document, we alluded to always wanting to sort of pay roughly 80%. It's actually in our fairly short operating history been a bit more than that historically. During COVID, we pared that back to preserve cash and to support our current royalty partners. And what we want to do is start to gradually increase that dividend back. But currently, the ratio is only 70% for interim 21, which I said is probably the lowest it's ever been for Duke. And I hope that provides a very stable base for us now to start increasing the top line cash revenue. And that should filter down into an increased dividend. We've often talked about, and Neil touched on very briefly there, the operating leverage of the business. And it's great to actually finally be able to sort of show it actually in the numbers, because I've been saying it for the last 2 years that we as a business have this high operating leverage, but now we can really see it. You'll see the top line cash revenue of 7.8 million, which was up 80%, as opposed to our core cash operating costs, which were only up 6%. Now, I would expect that kind of level to continue over the next 12 to 18 months as we keep building on that top line. We do have our limitations in terms of capacity, so our cost base isn't entirely fixed. As we add on sort of 10 million or so onto the top line cash, we will need to probably take on a few more people, but I think there's still significant operating leverage there. Other cash flow highlights to look at, really, I think, and again, Neil will come onto this a little bit later in terms of our deployment pipeline, but really there's an acceleration in the deployments. Historically, we've normally done about 25 million of deployments annually. Interim, as you can see, interim period, we did 23.7 million. So almost the annual average. And actually, since then, we've done 20 million post-period end into 4 million into a follow-on. And you may have seen very recently, again, Neil will talk about this investment, but a new 15.9 million investment into Atlas. So we're currently at 44 million for the year to date, and we've still got more than 3 months left of the financial year. So I think what that will mean will translate into higher cash revenues moving forwards. One of the additional effects of the increased cash revenue, obviously, is to increase the diversification of our revenue streams, and that's really key for a company of our size. We are growing, but we are still relatively small. So we want to increase that investment base, which will allow us to increase the revenue diversification and reduce really the risk. And I think you can see that very clearly here when in interim 2021, the top 5 revenue producers gave 83% of total revenue. That's now down to 64% in interim 22. And again, as we deploy more, I will expect that number to continue to reduce. Touching on the balance sheet, really the focus is on the value of the royalty portfolio, which has jumped from 85 million to 107 million. Obviously, you would expect this as we deploy more money. The loan portfolio has reduced on refis, and actually since period end, we have had one more. So actually that 1.5 million is actually now down to 1 million and just one loan currently outstanding on the book. The equity portfolio, I think, is very interesting. It's, as you can see, fairly decent increases. Now, we hold 8 equity stakes currently in our portfolio out of the 12 partners. We value those on a forward-looking EBITDA multiple, so I think you can probably understand why there is that sort of increase over the last 12 months as the underlying partners have come out of COVID. The general operating landscape is improving, and obviously the results are getting better. I would like to see those steadily improving over the next 12 to 18 months. I think there's still a lot of value in those equity portfolios. And again, it's a tough one to get through my auditors, who often like to be incredibly prudent and keep those valuations very low. So between the equity portfolio and what the royalty portfolio obviously also doesn't build in is the inherent value of our royalty premiums. So on each investment, we have a premium associated with the exit of that if the royalty partner was to buy back. Now, those premiums generally tend to be between about 10 and 30%. So across the portfolio currently, they are I would say they aren't built into the fair value calculations. I'm just going to skip to the next slide to highlight that. You'll see as at 7th of December, the cost and the fair value of the royalty portfolio is very similar. It's effectively sitting fair value is only just above cost. So what that means is it's not building into the value, the overall value, the value of those redemption premiums. Shifting back to just quickly, the other highlights really to touch on. Well, I'll actually speak later on the riverboats, but just when we sold those riverboats back in March, they were sold on a deferred consideration basis, i.e. we were due to receive 3 tranches over the course of 30 months. So it's I'm pleased to announce that obviously the first tranche of that, which was 5 million euros, was received post-period end. In terms of liquidity, the company's currently at a level of 25 million borrowing. We have a debt facility with Pollen Street. The facility is 35 million with a 20 million accordion. So that effectively means we have about 30 million of liquidity currently. Already touched on the accelerating deployments. Again, Neil will talk about this slightly later on, but you can see really what I'm trying to show here is sort of pre-COVID, the business was growing steadily, probably characterized by 1 to 2 investments per year. We put a halt on all new deployments during COVID, as I said, to preserve our cash and to support the royalty partners last year. We're out of that period now, and as the opportunity grows, we are looking to invest more. And I think that can be seen in that rather sort of steep rise in deployments. And I think that should hopefully continue over the next 12 to 18 months. So I think that's really the key points to take away from the finance part. As I said, it should be noted that 12 months ago it was the COVID period, so these are a very good set of results, and I'm very, very happy with them. But I think what's even better is potentially looking forwards the next 12 to 18 months. I think there's a huge opportunity here to continue the good growth that we've made over the last 6 to 12 months. Back over to you, Neil.
Thank you, Hugo. Yes, I've been keeping an eye on some of the questions that are filtering through too. So we'll try and make sure we touch on some topics. It's very interesting as we look at our royalty partners here, the page of 12 different logos, and talking about our acceleration. One of the comments was, "Geez, are we getting into trouble going too fast?" Kind of thing, and I would say that that we have continued from day one to talk about doing 4 to 6 deals a year. Of course, the deal size can go up with the portfolio size, but when you have a portfolio, and we're talking on this about our existing portfolio, I'm gonna touch on a couple topics. One of them is we're looking for companies that are buy and build strategy, like acquisition capital, and therefore it is the same company that will want more capital from us. And so the acceleration of deployments isn't going to waver from us doing our continued due diligence, the exact same long and involved due diligence with McKinsey and Company as our partner in commercial due diligence. We have third-party financial due diligence done. That process that takes 3 to 6 months is not going to change. We have the benefit of doing follow-ons with our existing investment, which can increase that. That's perfect for us. It's the same return as we got with a lower risk, because we know the company, and as long as they we have that opportunity to turn down the deal, so they have to come to us with the acquisition criteria that was same and is the same as our original investment. So we're not obligated to put more money in. They have to come with sensible deals. So I think we've shown that we can do that. Lynx is now up to 7 different companies under that UK umbrella. So we're excited about growth. Of course, the 78% was off of a COVID year as a cash basis, so that also was not normal type of growth. So wanted to talk about that, allay any fears of us going out and doing every deal in sight. That's definitely not going to happen. I've got a slide on that too. So our portfolio, I'm not going to go through every one of these companies. There's a lot of knowledge, I think, on this audience that knows our portfolio, but you can see a few things. Some were acquisition capital, which is good. We like MBOs, the management buyouts or management buy-ins that keep management as owners, and debt or equity refinancing. So we're refinancing out other debt that is short-term in nature, and the owners want the long-term capital that we provide and be done with refinancing risk. I think that's the third use case. You can see sometimes we have equity, sometimes we don't. We get equity when equity is up for grabs, so to speak, when equity is being rearranged, i.e. Fabrikat from earlier this year was a management buyout. The management now owns 70%, which is much better than a private equity-backed buyout. And we kept 30%, as we still got our cash rates and our IRRs are the same, and it's just some sweeteners that we can get in certain circumstances. But our model and our dividend and our business model does not depend on us getting equity, which is why we say minimally dilutive. It could be zero, could be a little bit, but it depends on the situation. It's just one of the levers that we have that we can decide to maneuver when we're trying to get a deal. And so we have our criteria and our targets for a return. We have different ways of getting there. So you can see, and I talked about off the top, we like differing sectors. We're not going to go into commodities. So we're not going to have something that depends on a gold price or an oil price, and we're not going to do startups that might have a huge huge increase. We're going to continue to do what we've done from day one, which is long-standing profitable businesses that have survived multiple now crises in the market, from COVID to the 08 and whatnot. The average company has been around for over 20 years in our portfolio, so we have that history, and quite frankly, the business owners remember that they can't get bank financing right when they need it in every crisis, and love that kind of no refinancing risk that we provide. So that's I think a range of our portfolio here. I'm going to continue to press along because I want to have lots of time for questions. Fabrikat, I think we've given you the flavor of this. Again, it's a company that's been around for 35 years and a management buyout. I do want to flip to something that we have not talked about, because this was last week's big announcement of the largest investment in our history, which was 21 million US, or 15.9 million pounds. Again, a company owned by one principal. It's a family business. His father started it. He's bought out his brothers now. Jim, and we refinanced out his debt, and he believes that his growth will continue. This is a very investable kind of private equity space. He is, with our capital, able to continue to grow. He's got 200 employees. He's got 3 plants across the South and Southeast United States. He's a top 10 national provider of those big signs you'll see on buildings and whatnot. And it's really a full service business, including maintenance and service. And it truly is one of the biggest companies that we've invested in. We had 2 other venture debt US based companies to compete against. What Jim really saw in us was for about, and it's kind of incredible that, you know, in a very low interest rate environment, the whole kind of the headlines and the newspapers talk about very low interest rates. The reality, because of the banking regulations and because of some of the covenants that companies need, you know, this is competitive. We look at 12.5%, and that includes principal. So the interest rate would be in the high single digits, and so in that case, you know, we are competitive with these companies. So we don't think that we are going to have to reduce our rates or anything like that. We're competitive, and we're going to continue to show you that we can get that this is competitive in this market segment. So it's a reflection of the banking regulations. I wanted what else to say about Atlas? You know, that's Jim believes, I think the exit is probably the only other thing I would say. You know, what does Jim, you know, what's in Jim's mind? Now that he owns 100% of the business, he is the driving force. He knows that he could sell to a private equity, but he wants that to be when the company is in the best financial strength and get a high multiple on his EBITDA when he decides to do that. So the fact that we never ask for a principal back, we can give him all the time he needs to get the company in that shape, and then he decides when he's going to exit. And I think that's a pretty good segue on back to Hugo to talk about some of our exits.
Yeah, thanks, Neil. I'm just going to talk very briefly, really, at 2 of our exits. Now, over the last 15 months, we've had 5 investment exits. I think that is realistic. Exits form part of the investment life cycle. I think 5 is more than we would normally expect, and I think most likely accelerated by COVID in certain circumstances. So I think going forwards, you should expect exits, but not to that sort of level. I'm going to touch on 2 of those exits really for differing reasons. The first, Welltel, being a sort of very good example of a successful exit, and second one being Tamarka, our riverboats, where we sort of had to get much more involved and restructure. But Welltel, to start with, we first invested back in 2017, and it was a telecommunications business in Ireland. It was Neil talked about earlier, so different scenarios where Duke puts its money, and this was very much a buy and build strategy. We funded, as I said, the first tranche in 2017, and then we funded 6 further acquisitions for Welltel. 2 of which came sort of during COVID. Actually, was the only deployments really that we made in interim 2021. Welltel was a real beneficiary of COVID and the working from home mantra, and sort of opened up opportunities for them to acquire other businesses. They got to a point where they had achieved scale. A private equity business came in and offered them a substantial amount of money ultimately, which for them was too good to turn down. So where we sort of ended was, the owners walked away with their windfall. Duke got refinanced out with our premium. So it was a really good example of how these buy and builds can grow quite quickly. The owners keep control through the process and are able to control the timing of the exit to benefit them, and obviously we get the benefit of the premium at the back end. Tamarka was a very different situation. For those of you who don't know, Tamarka were operators of 3 riverboat cruises down the Rhine and the Danube. As I think you can probably understand, an industry that was hit very, very hard during COVID. The whole industry shut down for 6 months. Revenue went right down to zero, and it effectively meant that Tamarka were unable to meet their interest obligations to us. And realistically, looking forwards, it was hard to see how they would be able to get back into a position where they could pay. We therefore took the decision to take action. But we did it in consultation with the owners of Tamarka. And what we did was we effectively restructured. We took ownership of the boats. We had first ranking mortgages on all 3 vessels. So we took ownership of the 3 vessels in exchange for forgiveness of their outstanding debt. What we then did was set up incorporated a new subsidiary in Switzerland to take ownership of those boats. And were prepared to lease them out on a bareboat charter. But ultimately, Duke, we're an investment company. We are not riverboat operators. And we were able to actually, through the connections made over the few years in partnership with Tamarka, we were introduced to a business called River Advice, who are the largest European operator of riverboat cruises. And we were able to sell all 3 boats to River Advice. Now that was done in March 21. We sold them for 11.6 million euros, which was the fair value of the loan and royalty on the balance sheet at that time. So we've actually received the first tranche of that, came in just after period end for 5 million. So there are still 6.6 million outstanding of that. But it's been structured in such a way as the next tranche of 4 million will be due the 30th of September 22, and the final tranche due in June 23. But Duke was able to walk away with a negative IRR of -2%, which I think from where we were was an extremely good result for everyone. So there's the exits. I will now pass back to Neil, really to talk about future growth.
Great. Thank you. Thank you, Hugo. We'll just kind of wrap up just on where we're going, what we see through the pipeline and this whole industry. And as I said off the top, we do something that has been around for decades in North America, and there's lots of flavors of royalties. But ultimately we are private credit. We play in that industry, private debt. This is a very, very large industry worldwide, but we are taking a proven credit business model and applying it to a new market here in the UK. And so although we have our roots in Toronto, and I'm Canadian, and that's where the biggest mining royalty and the first drug royalty, our chairman of our investment committee, Jim Webster, has been with me since day one, and he actually was the first ever drug royalty executive. He adapted the model from mining to drugs and royalty pharma and everything. He sold his company, but some of the biggest royalty companies right now are drug royalty companies that Jim Webster, our chief, our chief of the chairman of the investment committee, has started in 1992. So this is a very proven and large market. What we're happy and we're excited about is really every crisis is an opportunity. And post 2008, really the banking regulations changed to discourage loaning money to small businesses. The business owners themselves are willing to look at all other alternative other than just going to their banker. You know, back in the 60s and 70s, you go and get a loan from your bank. You know, it's innovation, and we're part of that new innovation in private credit. A lot of people will say, where do we play? I'm going to point to Apollo Capital, very, very large established private equity. They call it hybrid capital, really for those companies that do not want to sell to private equity. Apollo now has this hybrid value, which keeps the owners in control and keeps the managers in control. And it's passive investment. That in 3 years has grown to $13 billion. Now they're going to do $1 billion deals, and we're never going to see them and compete with what we do. Our niche is 2 million to 10 million pounds of EBITDA. It's a little lower than private equity. And again, we're looking for not all things to all people. We're looking for entrepreneurs who want to keep control of the business. They do not want to sell. And that is when we don't want to buy their company. We want to back the owners that have proven that they are a success. And so we're excited about that. For everyone who's new to Duke, I talk about these on the left-hand side of this page is the criteria that we use. I'm not going to go through that right now in the interest of time. You can look at that. It's pretty self-explanatory. And the pipeline of deals, we've seen a record number of deals. And I think it's just, we're a public company and we have a better market brand right now. But more importantly than the top number of 300 opportunities that have come to us, it's those ones that we've signed. And I want to express, as I have done before, that the real good quality companies are brought to us by trusted advisors of these private company owners. They're their lawyers or their accountants, or there's a lot of different private corporate finance advisors that if they're looking for capital, they will get these guys to look at them. Those are the people that we key on to get our pretty unique term sheet understood by them and ultimately by the business owners themselves, so that they can understand what 30 years and what's this and what's that and 13%. We are very competitive, and we can show that we're continuing to deploy, and our deployments are accelerating. So we have the UK all to ourselves. There are some North American competitors, and we compete opportunistically in that, and that's a very large pool as well, as you can imagine. But the quality of deals that we're getting are getting better and better. So we have new deals that are in the pipeline that come to us from the exact same advisors of the deals in our portfolio. So we're really excited about that. The numbers, we do one out of every 100 deals that we see. That's a testament to our process and our criteria. So we'll get on to questions here. We did 40 minutes, so we did pretty well on our timing. Just want to leave you with a couple important things. We're the only UK listed corporate royalty provider our portfolio is embedded growth into the portfolio, and on top of that, we have this liquidity. We have 35 million pounds of liquidity. We'll get on to questions about that, but we have the opportunity to build that growth in the future. We talked about the market opportunity and post-COVID, people in short-term, when there's short-term uncertainty, business owners look for long-term capital solutions. And we are the only long-term capital solution that is minimally dilutive. The fact is that we have a great group of shareholders, institutions from GLG and AXA, Canaccord Genuity Wealth, BMO, and there's a lot that I'm even forgetting, but they're on our website, and we're really pleased the institutional support and the retail support that we're doing things like this is very important to us. So thank you to all shareholders, even though you're not individually more than 3%, so I can't call you out by name. And as Hugo said, just to wrap up, we're really excited about the record cash revenue and the operating leverage that we're coming to see, and we're excited about the future as well. So thank you all for your attention, and Mark, I'll turn it over to you to moderate the questions.
That's great. Thank you very much indeed to both Hugo and Neil for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investment company dashboard. And I'd also like to remind you that your feedback is important to the company. And immediately after this presentation is ended, we'll redirect you for the opportunity to provide feedback in order that the company can better understand your views and expectations. Neil, Hugo, we did receive a couple of questions before today's event, so perhaps we could start with these, if I may. What happened to the riverboats which you repossessed after the start of the pandemic?
I hope I'll take that, Mark. I think I probably answered that question during the presentation in terms of the exits. As I said, we sold those riverboats back in March. We've received the first tranche of consideration for those, and the remaining consideration will be due September next year in June 23.
Perfect, thank you. And finally, can you add some colour to the investments which have done less well and expand on any lessons that would have been learned?
Yeah, that's a very good question too. So COVID was very unexpected, and it hit all of our companies in different industries and whatnot, and that's why we have a diversified portfolio. We did a lot of internal development. We went very much into a cash preservation mode, not only for Duke Royalty, but also our investee companies, and wanted to make sure that they were doing everything they could to survive COVID. And as I mentioned at the time, this feels more like 9/11 than it did the credit crisis. It was unexpected, but it might bounce back like we did in 2001. What we learned was it wasn't one company, one industry or the other. Every company was hit equally hard. What we learned was the quality of the finance function was whether we needed to help them through forbearance or something. It's the quality of the information. If you have good quality information, you can make good quality decisions. But so even though everyone has finance, we get monthly reports every month. We talk to our companies about them. It wasn't the information. It was how fast you could act on that. So that's what we found. And the bigger companies have better finance functions as a rule. But that's probably the one thing I'd point to.
That's great, thank you. Well, look, if I could hand back to you. You've received quite a few questions through today's meeting. If I could ask you to read out the questions, even who it's from, and give a response where it's appropriate, and then let me know and I'll pick up from you when you're done.
Yeah, no, I can start this one. I can see there's actually a couple of questions from Steve S regarding dividends. First, pre-COVID, your quarterly dividend was in the 70s pence. We're a long way back from that right now. Given the cash flow, record cash flow, can we expect that level to return in 2022? And then also, will you be disclosing the February dividend, please? And could you clarify the dividend policy? I'll do those in reverse, actually. It's the January dividend, actually, which we will be announcing shortly. So you will see news on that very soon. In terms of our dividend policy and the records cash revenue, the dividend policy has always been that we aim to pay out a high percentage of our free cash flow. A guideline has historically been 80% of free cash flow. We return back to shareholders. We are slightly below that at the moment, and I think that's come from being prudent with our cash preservation through sort of COVID. Also, what we definitely don't want to do is look at the record cash revenue and say, right, let's give a nice hike in the dividend, only to see problems in the next 12 months resurface, and then we have to reduce that dividend. So we want to avoid at all costs having to reduce our dividend again. So what we will aim to do is provide shareholders with a steadily growing dividend. So I can't guarantee numbers for you, but certainly the more we deploy, hopefully that should lead to increasing quarterly dividends.
Yeah, and I would just add on to that that's why a diversified portfolio. You know, if one company is not more than 10% of our revenue, then we'll be able to keep the dividend and not have any worries about future payments. But I'm going to gather a couple of these companies. Obviously, there are some new people on, which is great. I really appreciate that. And let me just get our product, answer a couple things about our product. One was about the exit penalties. Is that a deterrent? Is a harsh enough deterrent to get refinanced out? So one thing I didn't mention was that we actually have 3 years non-call. So you can't refinance out for the first 3 years unless you sell the entire business and there's a change of control. But no one can use us as short-term bridge financing or whatnot. So they're in it for the long haul as well. We don't want it to be a poison pill. So if they sell the business because COVID comes along, that's up to them. So, and then there was another one about the security. I did not mention, we do have senior security. We have, we are the debt. We have the security over the assets of the business. If there is a CID line or mortgage on a particular property, we have an intercreditor agreement with that. But we want to be the top of the capital stack for these royalties. So that is our security, and the equity is beneath us. So that's definitely part of the model that should be highlighted. And there was Hugo. There was one about the no return of payments on and how we get the model, how we account for the amortization period.
Yeah, that's. I mean, that's I guess more of a slightly technical accounting question, which without boring people too much on technicalities, it's because this is deemed a royalty. The principal repayments form part of the monthly cash flow, so it's treated as a cash distribution. There is capital repayments within that. But at the same time, if a royalty partner is to refi during the life of that royalty, obviously we get return back the full amount of capital. So in the books, it's it's fair valued, and therefore it's not like a loan where it amortizes and the value of that loan reduces over the life of straight line over the life of the loan. Because it's fair valued, the sort of the valuation on the balance sheet doesn't take account of those repayments until the latter half of the life of the royalty. So it's a sort of simple model, really. We account for all the payments as royalty payments, not as a deduction off the capital. But at the end of 30 years, it's all repaid. So it's actually fair. The royalty itself is reduced via fair value reductions. I hope that explains that.
Okay, we'll take that as a yes. There's a couple questions about inflation, which is a new topic, and I like talking about new things. And one was, are you concerned about over 6% inflation going forward, given your 6% cap? And the other one was, is it good for us? High inflation would be particularly advantageous to Duke. Well, certainly the plus or minus 6% is not that we think we're going to have inflation of 6%. It's really a replication of what has worked in North America, that we have replicated that business model. So we know that works, and we know that it's a fair adjustment between us and the business owner. So we've kept to that. But to the other question, we see that as an inflation hedge. When inflation is and prices are rising, that means that our payments will rise with that inflation. So we are insulated against the inflation hurting us. So it is beneficial to Duke. It is one of the features that we haven't really needed to talk about. But when you look at over the investment cycle and the business cycle, economic cycle, this is part of the features of this way of investing that benefits us and our investors. So we think that is good. Now, listen, if inflation is going to be with us for 3 to 5 years and +4 to +6%, we will be getting a lot of growth in our industry, but we don't anticipate that, and that might give heartburn to a bunch of our royalty partners if it was just an inflation adjusted for a period of 5 years, but I think that's unlikely.
I'll take a question from Mark B, actually, which is an interesting question. Hi, you referred to the Pollen Street RCF and the RNS data 15th of March stated you pay 7.25% margin on this debt. This seems very high. Any chance of lowering it? Yes, on the face of it, it does seem quite high, but I think a few things to note, really. First of all, it's a revolving facility, so we can pay that down, pay it back and draw it down again at will. And I think there is always a cost associated with that rather than just being a term facility. We are a growing business, but we are not significant scale yet to attract the very cheap debt. But given that we reduced that facility down from 9.5%, we are on the right trajectory. I think we are certainly going to look to try and get cheaper financing. I think given our investment base, as I said, it's unlikely we're going to be able to get to the sort of L+4, L+5 numbers. But certainly, I think there is an opportunity over the next 6 months, possibly to lower that sort of cost of debt a little. Yes.
I'm going to rattle through a couple easy ones or short ones. Do you pay, Chris A, do you pay introduction fees for deals that complete? Yes, we do. And that is part of the cost of our companies. There was one other that I remember seeing about kind of outsourcing those the due diligence. We do a lot of the due diligence in-house. So the financial models, the structuring, and what I was referring to was the commercial due diligence. So we have a long-term relationship with McKinsey and Company. For those of you who've been with us for a long time, we had a relationship with Oliver Wyman before, which really gave us access to their experts in every industry. And McKinsey is exactly the same. And we only pay them on success, and they basically get a royalty of our royalty. So we're perfectly aligned in terms of doing the right deals. If we don't get paid, they don't get paid, and we only use them for the commercial aspects and their understanding of the industry that we're going into, which reduces our risk. And if we don't like the industry, that we get that information for free. We don't have to pay them to get access to that information. And so it's a long-term partnership kind of model. And that's disclosed in our financial statements. So that is that. The other two that I just wanted to clear up: are all partners up to date with royalty payments? A very good question. That everyone is, except Trimite, which is one of the 4 forbearance that we talked about last year at this time, and they're paying half, and they're accruing the other half. So we're not losing value. We are. That's the last kind of forbearance that we've structured that still continues to this day. Should be within 6 to 12 months, be right up to date. And then the one question about if we're converting one opportunity in 100, are we being too selective? That's also a very good question. And I would only hasten that. That's why I don't really consider the top number. If you get on a mailing list, you can get a new company for sale a day. So we don't really consider those as where we're actually even spending any time doing them. The 45 NDAs that we do really look at, that is filtered our first filter, our first screen. And if we like a company, we get that. So we are very selective. We're not all things to all people. We're not going to, if a company is too small, we don't want it. If a company is too large, they could probably get a lower cost of capital. It's that, as I said, 2 million to 10 million EBITDA company that has and they're not for sale. A lot of these companies will be for sale. So out of those 45, if we get 45 NDAs signed and we do 3 or 4 deals, that's 1 in 10, and that's probably, we're spending time on those 45 for sure. And converting 1 in 10, I think, is a good metric.
I could probably just answer one final one, Neil, just before we stop, because it's a very quick one. Peter R says, you mentioned a collar on payments. Is there a cap if they have an exceptional year? Yes, our increases are capped at 6%. The collar is 6% either way. So even if the royalty partner's revenue increases 50% in 1 year, the maximum our yield can go up is 6%.
Perfect. I don't know whether I should jump in and thank you, but every time you answer a question, another one comes in, guys. So what I'll do, if it's okay, is any further questions that come in from investors, I'll make those available for you guys. And if there's anything additional you want to add, just let us know, and we'll publish those to the investors. I know investor feedback is important to you guys, and I'll shortly redirect investors to give you their thoughts and expectations. But Neil, perhaps before doing so, I could just hand back to you just for a few closing comments to wrap up with.
Well, thank you, Mark. Wanted to say a big thank you to all the shareholders and potential shareholders on the call. Me, on behalf of Hugo and the whole team at Duke Royalty, are really excited about sharing our record results for the first half of fiscal 22 with you today. And I hope we gave you a flavor of what we do, our results to date, our portfolio, but more importantly, how excited we are for the next 12 to 18 months in the next phase of our growth. So thank you all for your attendance.
That's great. Neil, Hugo, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide feedback in order that the company can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team at Duke Royalty, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to you all.